Hey, what's up, you guys? Welcome back. So, long time no see, and it's time for another market update. By the way, if you're wondering why I'm wearing a McDonald's hat, I promised in my previous video that I'll be wearing this until the bear market is over. So, it's not over yet, although recently the market has been rallying. So, I'll talk about that in the video and what do I think about it going forward. But let me just recap what has been happening for the past, I don't know, a few weeks or month or so. There's still a lot of risk factors out there. The U.S. stock market has been, as I said, rallying recently, but the U.S. CPI also just came out at the highest it's been in 40 years. Okay, so it came in at 9.1% year over year inflation. And this is CPI inflation, by the way. So CPI, in case you guys don't know what it stands for Consumer Price Index. It's a basket of goods, and they've changed the things that go into CPI since it was first invented. So a lot of people are saying that, you know, CPI is not even accurate because they change it all the time, and they're measuring things, not in the most scientific way possible. Right, so a lot of people are saying that the true inflation rate is probably around 14%, which I mean, it's believable, right? Because if you go to the grocery store recently, if you live anywhere in like US, Canada, it's not just the US, right? Like here in Canada, inflation came in at 8.1% year over year. So if you go to the grocery store, though, in like America, Canada, parts of Europe, you'll find that inflation's probably higher than 8.1, 9.1%, right? Like the stuff has gone up more than that. But whatever, let's just say that it's 9.1% in the US. That's still incredibly high, right? Considering that inflation usually, according to the Fed, it should be targeted to be pegged to around 2% per year, right? So yeah, that's actually not very good. It's not a very good sign. But what's my outlook on the market going forward, right? Because recently, though, the market has been rallying because I think a lot of experts and a lot of analysts are expecting that that's probably the highest that inflation will go, 9.1%, and then it will start coming down from there. I think I kind of agree with that because oil prices have been coming down recently, and as we know, oil kind of drives everything, right? As much as I like to promote renewable energy and promote green energy on this channel, and I'm a big supporter of, electric vehicles and all that stuff, it's still not good enough. That technology is still not advanced enough to just replace everything, right? It's going to take time, and until then, a lot of the stuff that we rely on is still relies on oil to ship products where they need to go. So it's definitely a good sign that oil prices have been coming down, so that should help with disinflation, right? So what's my outlook though? I'm going to make a bold prediction right now, okay? So if the market has not already bottomed, now there's a good chance that I think that around like mid-June was when the bottom was, but let's just say that that's not the bottom. If the market has not already bottomed, the market, I believe, will bottom within the next 60 days. So 2 months. So if you count 60 days from now, it'll be around like mid-September, late September-ish. I believe that, at most it'll take until then if it has not already bottomed. And the reason is I think the Fed is going to be done raising interest rates soon, or they're going to pivot or U-turn or whatever you want to call it. And I'm going to give you a few charts just to put this into perspective. So these charts are from James from Invest Answers. So shout out to him. If you haven't checked out his channel, give his channel a checkout, right? I'll borrow a few charts from him. So first, this is James's model on Fed interest rate hikes. If the Fed continues to hike interest rates until the end of the year, at the current pace, they'll reduce US GDP by over 6% if they actually get to the terminal rate, which I think they want to get to like a 3.5% or 3.75% terminal federal funds rate by the end of the year. If they do that, then they'll reduce US GDP by over 6%, which is $1.5 trillion. And that will for sure cause a pretty steep recession. So keep in mind that I'm assuming that they're doing or this model is assuming that they do 50 basis points at the next meeting, which is coming up this week. But I personally think that they're going to do 75. Now, some people think that they're going to do 100. I personally don't think that they're going to go quite that heavy, but you never know. But 90% chance they're going to do 75 basis points, which makes everything even worse compared to what the model says, right? Because they're just speeding up the rate hike cycle, which means that they're going to crash the economy harder, faster, and they're going to have to pivot faster as a result, right? Pivot means that they're going to stop raising interest rates or even start cutting interest rates. As I said, if they do 100 basis points at this point, the stock market might actually, see it as like a good sign, right? Like as counterintuitive as it sounds, if they do like a larger rate hike, right, or even 75 kind of is a pretty big step, right? So I think that the more aggressive that they go, the market might actually in the long term see it as like a good sign, because the more extreme they go, the more extreme the U-turn is going to be. But anyways, many economists have also said that the tipping point of debt to GDP, which is what it sounds like is the comparison of your debt, national debt to GDP, is around 77% or so, which means that if you go above 77% debt to GDP, you can no longer, you have to rely on printing money on your way out, right? You can no longer like actually pay back the debt that you borrowed without debasing the currency. That's what it means, right? So you have to continue to print money to prevent the system of collapsing, right? So this theory is debated as to whether or not it's actually 77%, because that sounds like a really oddly specific number. I'm sure there's a reason behind it. I'm not like an expert PhD economist, so I can't tell you what the exact model is that arrived at that percent. I'm just telling you that that's kind of one point of consensus among some experts, right? So again, there's debate as to where that tipping point is, but just to keep in mind, the US debt to GDP is around 130%. So even if the tipping point is not 77%, if you want to say that is higher, well, we're well past that. So another chart. This is what's called the Fed Pivot Indicator, which is the 5-year yield versus the federal funds rate multiplied by the national debt. So in simpler terms, this is basically showing you how much money you have to pay to service national debt. And the higher this yellow line, the more it costs you to keep up the debt and not default on the debt. So the issue is that the US government currently has around $30 trillion worth of debt in total. And when the federal funds rate goes up, it becomes harder and harder to actually pay that debt. So if you want a simpler explanation as to why the Fed must pivot at some point, just think about it this way. If you owed a bunch of money, as in you borrowed a bunch of money and you're struggling to pay it back, but you can, let's just say you can control the interest rate on your own debt, right? Do you want that interest rate to be high, or do you want that interest rate to be low? Like, do you ever want to raise the interest rate on yourself? Of course not, right? Like, naturally, you'd want the interest rate to be as low as possible. And this is kind of the conundrum and the dilemma that the US Fed is in right now, right? So when inflation rate came in at 9.1%, everyone's like, oh crap, we're done. The Fed is going to raise 100 basis points. Well, now I'm hearing that, one of the Fed governors or something, they're like hesitating. They're like, no, we got to be more careful with raising interest rates. Let's still do 75. Like, he didn't say it exactly in those words, but essentially that's what he said, right? So I think you're already starting to see the cracks, and in my opinion, this is an early sign of a Fed pivot. So I think that we're going to get much more clarity come September, but usually the stock market is forward-looking, so by the time we start to get confirmations of a Fed pivot, I think stocks would have already rebounded significantly, and you would have missed the best part of that rebound if you start buying then, right? So I do think that again, not financial advice, but for me personally, I believe in deploying assets or deploying cash when assets are down, right? Like assets, I mean stocks and crypto and more risk on assets. So I think that now it is a great time. Again, not financial advice, just my opinion, right? So I've been paying back some debt recently in anticipation of deploying the rest of my funds and stacking cash to deploy within the next 60 days. So within the next 60 days, I expect to be pretty much all in, right? Like 100% into the market. And I think right now I'm like, 10% cash ish, right? But I'll make a separate video talking about the specific things that I'm buying. But yeah, I mean, I'm like very heavily in the market already, but I'm going to be like actually all in within the next 60 days. At least that's the plan, unless something like crazy happens and something drastic changes, but I don't really foresee it. I do still think, though, that there is a risk of a final capitulation because from what I've heard, you haven't seen like retail investors, like just regular people like you and me, just panicking and selling. Like a lot of people are actually still buying the dip, right? So I think that might be a risk factor. We haven't seen like a washout of the retail traders, but it's possible that this time is different, right? I know people hate those words, but maybe it is like this time is different, right? Who knows? But yeah, I do still think that there is a final capitulation risk, which is why I'm not going all in like tomorrow or something. I think that this is still one of the best buying opportunities in a decade, though. So here's another thing you got to think about, right? You don't always have to buy the absolute bottom. Like, what if you don't catch the bottom? Like, big deal, right? You're not always gonna catch the bottom, and you're not always gonna be able to sell the top either, right? So it's just you can't time these things perfectly. And even if you didn't catch the absolute bottom, you started buying when the market already started rebounding on the way back up, like it rebounded like 10%. Well, then it could, when the rebound actually like finishes, it'll probably go up by a lot more than 10%. And even if we get more capitulation, I think long term you'll still look back on 2022 and be like, wow, that was one of the best times to buy in. But yeah, anyways, I'll leave the video here. Consider subscribing if you like this series, and be sure to press the thumbs up button. And be sure to follow me on Twitter and Instagram, links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye.